Hello out there again. This is Peter Harris from Commercial Property Advisors, also author of this book, Commercial Real Estate Investing for Dummies, and coach and mentor to many commercial real estate investors all across this great nation of ours. The title and subject of today's video is Creative Financing for Commercial Real Estate. It's really important that you know how to structure deals that no one else does. What if you don't have enough of a down payment? How do you close that deal? What if you find a great deal that's distressed? How do you finance something like that? What if the seller has a great property with great upside but has no financials? How do you creatively structure and close that deal? Well, in my experience, real estate agents are not the best source to learn how to be creative in commercial real estate. They're more concerned about their commission, and rightfully so, because they have to make a living, so they're not a good source. And also in my experience, nearly 95% of all sellers have no clue how to creatively structure anything creative. So they're not a good source either. So who's left? It's you. So it's going to be up to you to learn this topic very well. So in this video, I'm going to dive deep into details on how to show you how to creatively close deals that you otherwise would have possibly passed on. Okay, so let's get started. I'm going to go over 7 things today with you today. Number 1 is the 3 fundamental creative financing strategies. Every single deal that I've seen done creatively are bred from one of these 3 fundamental strategies. Number 2, I'm going to show you how to structure deals, commercial deals, with little money, credit, or experience. The key word here is little money. In commercial real estate, you do need a little bit of money. Number 3, I'm going to show you how to finance a distressed commercial property. You're going to find out there's lots of motivated owners with distressed properties that banks won't touch. How do you finance those? Number 4, I'm going to show you the single most important mentality to have when structuring a creative deal with a motivated seller and a ready and willing property. Number 5, I'm going to share with you why would a seller even consider creative financing. I'm going to give you 4 reasons why they would even consider creative financing. Very important topic. And number 6, the 1 secret to creative financing. Yes, it's very simple. It's not what you think it is, but it's very powerful. I'm going to start here though. I'm going to start with number 7, the power and importance in knowing how to structure creative financing for commercial property, and more importantly, why you would do that. All right, let's jump into the power and importance of knowing how and why to structure commercial deals creatively. Number 1 is leverage. Don't you agree that there's power in knowing how to lower your down payment? All right, there's power there. Don't you also agree that there's power in learning how to avoid banks and lenders and creatively structuring your commercial deals? There's great power there. Number 2 is you have the cash, but not the credit or experience. So these guys have recovered well from the recession. They built up a little bit of savings, but they have no credit and they have no experience. They're not favorable to the bank, right? So how do you structure a deal like that? They found a great property. They have the money, but they don't have these 2 requirements here to get to commercial property. So there's power in knowing how to do that. Number 3, I said number 3 for you commercial wholesalers out there, or those of you wanting to wholesale commercial properties out there for big dollars. We teach that in our company here, how to structure wholesale deals that are small and on the large side. And if you were to structure a creative deal, let's say with a master lease, with the seller carry second mortgage, seller carry first mortgage, all those type of things that are really, really cool, that I'm going to teach you in a few minutes. If you were to structure a deal like that and take it to your buyer, it will immediately give the impression to your buyer that your deal is unique and very desirable. All right? Very, very important here. Number 4, knowing how to structure creative deals, it gives you a way to finance distressed properties that a bank wouldn't touch. You're going to run across quite a few of those as you jump into commercial real estate. Number 5 is how to deal with a seller who wants to sell, right? He wants to sell, but he's concerned about his capital gains taxes, all right? How do you deal with that? you're going to run across quite a few of those sellers. And you must know how to structure deals where you can, quote unquote, avoid or delay their capital gains returns. I'm going to show you how to do that in an example in a few minutes. Number 6, you're dealing with a seller who is ill, elderly, or burnt out. Now let me stop here for a second. How many of you know a seller who is ill, elderly, and burnt out? You know, either residential or commercial. How many of you are raising hands? I bet a lot of you have seen those type of sellers. All right? How do you deal with those? I bet some of you have unknowingly passed through or passed on quite a few of those deals because you had no clue of how to handle those sellers. Well, after this training, you're going to know how to deal with them. All right. Number 7, it's just plain fun. Putting together creative commercial deals is just plain fun. It's so fulfilling for me and for my students. I would say that roughly half of the deals that we do have some type of creative component. So it's just a lot of fun. And lastly, I know for a fact that some of you have run across this situation, all right, where you need to leverage, where you have the cash but not the credit, where you found a distressed property or distressed owner and you had no clue of what to do, all right? Or maybe one of you are trying to sell a property and you fit in one of these categories, right? So this video is for you. So the next few minutes, I just want you to pay attention and watch closely and understanding that there is power and importance of knowing how to creatively finance commercial real estate deals. All right, let's get into the one secret to seller financing, the one secret for creative commercial financing. All right, here it is. I'm going to unveil it right now. Here's the one secret. The one secret is to ask. That's right. There is power in asking. In life, if you do not ask, you do not get. That's how it works. In real estate, the same thing. Especially when you're doing something creative, you must ask the seller. Here's how you ask. You would say, Mr. Seller, would you be open to any type of seller financing? You see? Pretty simple, right? Now, if the seller says yes, what do you have in mind? You would just say, I'm not sure yet. I just want to see if you're open to it. I'll get back to you. That's simple. If the seller says no, okay, to us, no means not yet or yes to something else, okay? That's the mentality you have when dealing with sellers with seller financing. No means not yet or yes to something else. All right, next, I have just one rule when asking, okay? One rule I want you to follow. Here's the one rule. The one rule is never ask for seller financing on their first phone call. All right, that will tell him that you have no money and you will scare him away. So that's my one rule. All right, so never ask for seller financing on their first phone call. So now I want to jump into more of the meat of the video. I want to go now into the 3 fundamental strategies of creative commercial financing. All right? All right, let's get started with the 3 fundamental creative strategies for commercial real estate financing. Nearly all of our creative deals that we've done in our company have all started with this, with 1, 2, and 3. Now, it's really difficult to create anything of value without a solid foundation. That goes for life as well, right? Now, in commercial real estate, that is so true. The 3 fundamental strategies that you really have to learn are, number 1 is the owner-carry first mortgage, the owner-carry second mortgage, and the master lease agreement. In a few minutes, I'm going to give you an example. I'm going to break down all 3 of these for you. But first, let me give you a quick 10-second explanation of each, and then we'll dive deep into the details. Okay? Number 1, the owner-carry first mortgage is exactly what it is. The owner is carrying the first mortgage. He is being the bank for you. For example, let's say the purchase price of a property is $100,000. I'm just making it up. And the down payment is $10,000. That means the mortgage is going to be $90,000, right? So the seller is going to carry the mortgage for you. This is great for properties that are owned, free, and clear. Now, when I dive deep into details on this one here, I'm going to give you a few examples of when and how to use this strategy, all right? Number 2 is the owner-carry second mortgage. Like the first, the owner's carrying a second mortgage for you. So that means their first mortgage is with the bank, the second mortgage is with the owner. Here's a quick example. Let's say that the bank is requiring a 25% down payment, which is quite typical, right? Now, but you only have 15% of the 25. What happens to the other 10%? Well, in this strategy, the owner can carry that shortage, that 10% for you. So the bank will carry the 15% mortgage, and the seller will carry the 10% mortgage, equaling 25%. It's a great way to leverage and to increase drastically your cash on cash return. All right, again, I'll give you a deeper example of this in a couple of minutes. Now, number 3 is the master lease agreement, and you guys know that that's one of my favorite techniques to use when buying creative commercial real estate. However, in this video, I'm not going to go any further on this technique because I have another video on this channel that explains it completely. Okay? So again, nearly all of our creative deals have begun, are bred from the owner carry first, the owner carry second, and the master lease. Now what I would like to do is give you a quick example, a little deeper explanation of the owner carry first mortgage. Strategy number 1 is the owner carry first mortgage. In this part of the video, I'm going to give you a quick example of how an owner carry first mortgage works first, and secondly, I'm going to share with you where it's useful for in this section right here. Alright, so let's get started here. Let's say you have an 8-unit apartment building and the purchase price is $500,000 as an example. Okay, you found this property. Now let's quickly compute the income and expenses. Alright, so we have 8 units at $800 a month times 12 months is equal to $76,800. Okay, so now we have the income. Next is the expenses. Now we're going to take away 35% for a typical and normal expenses. 35% of $76,800 for expenses. I'm going to do that subtraction, and I come up with $49,000. So income minus expenses equals $49,000. That's, by the way, the net operating income. Very important term. So now I have the income, I have expenses. What's next? Got to figure out the mortgage. All right. So in this deal, we have negotiated a 10% down term. Why? It's because the owner owns it free and clear and he can be the bank. So we're going to offer him 10% down on this property. 10% of $500,000 is $50,000. So your mortgage is going to be $450,000, right? Now, let's figure out what the payments will be. I'm going to make this up again. All right, so payments can be 5% with a 30-year amortization. Pretty typical. All right, so those payments will be about $2,400 a month, which would be about $29,000 a year. So we have mortgage payments at about $29,000 per year, okay, mortgage payments. So what I do next is I'm going to subtract my mortgage payments from my NOI. So if I do $49,000 minus $29,000 equals $20,000 per year in cash flow, all right? So that's my cash flow, $20,000 per year. Now to do ROI calculation or cash and cash calculations, basically you would divide your annual cash flow by your down payment, right? So $20,000 divided by $50,000, that's a pretty good cash and cash return, all right? So you do the math. That's really, really good. That's only possible because you put down 10%. That's only possible because now you understand the owner carry first mortgage. And it's only possible because he owns the property free and clear. So owner carry first mortgages are great for free and clear properties. All right, very useful. So the next time you find an owner who owns his property free and clear, check out this strategy and see if it works for him. You now know how the math works, right? It's also useful for distressed owners. It's also useful for when you have little cash, no credit or experience. Why? Is because if you have little cash, let's say you wanted to buy this property, it will from a bank it will probably cost 25% down payment. But because he can be the bank for us, we're able to put down 10%. You don't need credit or experience because The seller is the bank. There's no credit requirement other than what the seller wants to see. Next is, this is really cool, if the owner needs to delay paying capital gains taxes if he sells. So the owner carry first mortgage works really, really well for that. In fact, that little technique is called the installment sale. All right? I'm not going to go over this now, but installment sale is a very, very effective technique if the seller needs to somehow split up his capital gains taxes over the course of years. For example, let's say that he owns this property free and clear and he's about to make a huge profit. He doesn't want to pay one lump sum of taxes. You can do an installment sale with the owner carry first mortgage, and you can buy his property over the next 5 years 20% at a time. See, something like that. So you can be as creative as you can be on this type of strategy. All right, okay? In summary, this is the owner carry first mortgage. Now you know how to calculate the cash flow, the cash and cash return, and this is what it's useful for. The next thing I'm going to go over with you is the owner carry second mortgage. Fundamental strategy number 2 is the owner carry second mortgage. Much like I did in the owner carry first mortgage, I'm going to share with you the concept of how the owner carry second mortgage works, and then I'm going to give you how and where to use it. All right, so let's get started. Let's say that you have an 8-unit apartment complex, commercial property, $500,000 purchase price. And the down payment from banks are typically is going to be 25% on average. Okay, so 25% of the purchase price of $500,000 is $125,000. What if you couldn't come up with the entire $125,000? But the seller is motivated. He wanted to sell, but all you had was $50,000. But the bank wants a total equity of $125,000. What do you do? Well, what you do is you have the seller, the owner, carry a second mortgage in the amount of $75,000. He carries the $75,000, you have the $50,000, you meet the bank's $125,000 equity requirement. So the bank is happy, you get to buy their property, and the seller gets to sell his property. One other small but important detail I need to add is when you do your calculations on cash flow, don't forget that you're making a second mortgage payment. You're making an interest-only payment on the $75,000 to the seller. Okay, so that means that you're going to have 2 mortgages to pay. So make sure the numbers work out. So here's how this is useful and where and how this can be used. Now, again, let's say you have a motivated seller, but you only have $50,000 of the $125,000. Well, this is useful for when you need to leverage, right? You're leveraging your $50,000 into this deal because you have a down payment shortage. So it's very useful for that. But you need to have a motivated seller for that to work. So when you have a motivated seller and a ready and willing bank that will allow a seller carry second, you can leverage your $50,000 into a $500,000 property. Now, what it does is when you're putting down $50,000, that's your outlay, your investment, instead of the $125,000, well, what basically it's going to increase your cash on cash return. So in this case, your ROI, your cash on cash return is going to more than double than it would be if you were to put down $125,000. So the seller, the owner carry second mortgage is a great way to not only leverage but to just go through the roof on your cash and cash and ROI. When you see this language here, let's say that you're on LoopNet or any other type of online community where you see commercial properties, or even maybe in a flyer, you see this language here, seller financing available. If you see that, or you see owner may carry, all right, that is code language for motivated seller, for seller needs to move this property. So this is code language for bring me something creative. Now you know what to bring them. You see this language, you bring them an owner carry second mortgage offer. You now know how and where it's useful for the owner carry second mortgage. The next thing I want to discuss with you is why would a seller even consider creative financing with you? So I'm going to share 4 reasons of why that may be possible. In this part of the training, I am going to answer the question, why would a seller even consider creative financing? why wouldn't the seller just go ahead and just put their property on the market and just sell it? Why wouldn't he just pull in a cash buyer and sell the property for the price he wants to be done with it? Well, in many cases, he may not be able to. And the reason why is because of these 4 reasons. You guys have just learned how to put together conceptually a seller carry first mortgage, a seller carry second mortgage, and a master lease. You can now take those 3 strategies and see if your seller falls in one of these 4 categories or reasons and apply what you just learned. All right, let me get started. Number 1, the first reason why a seller would even consider creative financing is if his property has high vacancy, is in poor condition. These days, if a property is 80% occupied, it's considered distressed these days. All right, so a bank wouldn't want to qualify the property for a loan, so how could you sell it for top dollar with a high vacancy? Same thing in poor conditioning. Property is in poor condition, same situation as this here. So if a property suffers from this and the seller still wants to sell the property, the only way to get his price is to do creative financing. Got it? Number 2, let's say the property is in good condition. The condition's okay, but the seller's not. What if the seller kept no books and records of the property? Amazingly as it sounds, a lot of commercial owners keep very poor records of their income and expenses. It doesn't allow you to validate how much the property makes. If it doesn't allow you to validate it, the bank is going to have the same problem, so the bank is not going to give you the dollars you need to buy the property. The banks may do that, but they may want to ask for a large down payment to protect their downside, and the deal makes no sense. When the property is okay, but there's nothing to substantiate the pricing, that's when creative financing may come into play. Number 3, let's say the seller has concerns about paying capital gains taxes if he sells. We already learned from a previous video about the master lease, which is a creative financing technique. You also learned of the owner carried first. In both situations, we can mitigate his concerns about paying taxes when he sells. We can mitigate it by spreading out over time his capital gains taxes. So you can look at an installment sale, you can look at a master lease, you can look at an owner carried first mortgage as a way to mitigate this. These 3 reasons are out there. When you're looking at a lot of deals, commercial deals, and you are talking to the seller directly, you're going to run across these 3, I guarantee it. Number 4 is the seller needs a quick sale because of a life situation. For example, if the seller is ill, going through divorce, or being relocated, he needs to sell the property quickly. Sometimes for privacy's sake, a seller does not want to list the property on MLS or on online and wants a quick sale. All right, so in any case, when a life circumstance requires a quick sale, the best way is to do creative financing. All right, so the next thing I want to talk about is what is the single most important mindset that you need to have when you are putting together a creative commercial deal. The last thing I want to share with you today is what is the single most important mentality to have when structuring creative commercial estate financing. All right, here it is. It can be summed up in one sentence. Mr. Seller, I will give you your blank if you give me my blank. All right, so this is going to set your posture moving forward when you structure anything creative in commercial real estate. All right, so watch this. Mr. Seller, I will give you your price if you give me my terms. That's your posture. All right, always. That's the single most important mentality to have when you're structuring anything creative. If the seller wants his price, you get your terms. Repeat after me. Mr. Seller, I will give you your price if you give me my terms. That's your posture moving forward. So when you want to put together anything creative like the seller carry first, seller carry second, or master lease, this is your posture. Mr. Seller, I give you your price, but I want my terms. Now, you guys are probably wondering, how do you come up with the terms? That's easy. The terms will come up via the seller's motivations. So what we do, we ask the seller a bunch of questions, we visit the seller, we look at financials, we do an evaluation, we listen very carefully, and we come up with the seller's motivations. We take those seller's motivations and we structure the creative deals. All right, that's how you do that, okay? So terms come from seller motivations. I'm going to give you a quick example here of how that works. Here you have one question but two potential answers, and it will put together how you come up with the terms from the seller's motivations. Three quick examples. Example number one, if the seller inherited a property that's in high distress and wants a quick sale, what's most likely to work? A, is it a small down payment, 10-day due diligence, and 15-day close? Or is it a large down payment or 60-day close? Again, the question is, if the seller inherited a property that's in high distress and wants a quick sale, what's most likely to work? A small down payment, 10-day due diligence, and 15-day close, or a large down payment and a 60-day close? The answer is A, right? Because what's the motivation? He's distressed. He needs a quick sale. So a small down payment may be okay. 10-day due diligence as opposed to 30 will be great. And a 15-day close. That will get the deal done. So that's how you measure the motivations versus the terms. Second example. The seller wants to delay paying capital gains if she were to sell. So what's most likely to work? An outright sale with a wealthy cash buyer and close in 7 days? Or a master lease term over an extended amount of time that you and the seller agree upon? The obvious answer is B, the master lease, where you extend the deal out because their motivation is what? She doesn't want to pay, or she wants to delay her capital gains. Again, what's the motivation? We set the terms. Here's the last example, then we're done. The seller wants to sell but would like to maintain some type of monthly income from the property. What's most likely to work? A master lease where you structure a monthly payment plan to him over and above paying his mortgage, or B, a master lease where a joint venture where he shares in the profits when you sell the property years down the road. What's the answer? What's the motivation? He wants to sell, but he wants to maintain monthly income. So the answer is A, a master lease where you structure a monthly payment to him over and above the mortgage payment. So now you have an idea of how to listen for the motivations and structure them into something creative. Okay, so I hope you enjoyed today's video. If you want more videos like this, please go onto our website, commercialpropertyadvisors.com. Thank you for watching 3 fundamental creative strategies for commercial real estate. I will see you at the next video.